Thank you, thank you. I wasn't expecting that applause. Can you hear me okay in the back? Yeah, perfect, got thumbs up. Okay, great to see so many of you here today. We've got a lot to get through, so I'll get straight into it. And I just wanted to start with this picture. I was told about this last week from Helen and Andy, and it shows that Rachel Reeves has taken down the photo or the picture of Nigel Lawson and replaced it with Ellen Wilkinson, or Ellen the Red, as she's otherwise known. So she was a member of the Labour Party, but she was also one of the founding members of the British Communist Party, which I think says something in itself. But this reminded me of another story that I'd heard about Rachel Reeves and posters on the wall, at this time when she was at university. So she had a picture on her wall of her economic idol. Does anybody know who that was? It was Gordon Brown. So Gordon Brown was her idol from an economic point of view. And what Gordon Brown used to say was, hit the taxpayers hard in the first year or two of government. Hit them hard, get the pain out early, because in 5 years' time, when you've got to call a general election, voters will have forgotten about it by that point and you'll be home and dry. And Rachel Reeves certainly took a leaf out of his book, because when it comes to tax cuts, there wasn't really anything to write home about, really. The most I could get was the fact that the tax thresholds are going to be unfrozen after 2028. That's about as good as it gets. In terms of tax increases, well, we know there was a lot of those, 40 billion of them in total. Here are just some of the main ones. And of those 40 billion, the employer national insurance is by far the biggest tax intake. So roughly about 60% of that 40 billion comes from the employer national insurance. So it's about 24 billion. But that's not where I'm going to start this morning. I'm actually going to start with the inheritance tax changes, because whilst it's not the biggest announcement in terms of tax receipts, it's going to have a big impact, certainly on our clients, most people in this room. So that's where I want to start today. And I'm just going to start with what didn't change, because there was lots of rumours about what might happen. But there were no changes to the rate of inheritance tax, so that still stays at 40%. There's no changes to the tax-free allowance, what they call the nil rate band. That stays at 325,000, and that's going to stay to the end of the current Parliament, 2030. The residential property allowance, that still stays as well, and that was a bit of a surprise because there were rumours that that might go. This was something that the Conservative government brought in, which says if you leave your main residence to a direct descendant, you can then get an additional 175,000. And there were rumours that that was going to go, but that has been kept as well till 2030. So an individual has the standard 325,000 allowance, plus the residential allowance of 175, that's 500,000. Married couples, they've got £1 million between them. The 7-year rule, as it's known, that didn't change either. So there were also rumours that that might go up to a 10-year period, but that has stayed at 7. So when you make lifetime gifts, you've got to get over a 7-year threshold before that gift comes outside of inheritance tax. And lastly, no changes to the spouse exemption. So that's what didn't change. Now for what did change. And remember, I am just a messenger here. So starting with pensions, so from April 27, subject to a consultation on how it's actually going to work, pensions are going to be brought within the scope of IHT. So they're currently exempt. April 27, they'll now be within the IHT net. From the documents that we've seen so far, the pension scheme administrator is going to be responsible and liable for reporting and paying the inheritance tax. So they'll calculate what inheritance tax is due, and they'll take that directly out of the pension pot before it's been passed on to the beneficiaries. And therefore, the executors of an estate and the pension scheme administrator, they're going to need to liaise with one another. They're going to talk about the assets in the estate, what allowances there are, and some of that nil rate band, that 325,000, can be apportioned to the pension pot, and you can work out how much inheritance tax is due on that particular pension pot. Then the scheme administrator will deduct it out of the pension pot before it's passed on. So in terms of like an illustration, let's say you've got a pension pot 500,000. It's now going to be subject to inheritance tax, so it could be at the fallback of 40%. So 200,000 goes in IHT, and that's left to the beneficiary of the pension fund. They get 300,000. Now, if that beneficiary then wants to access that pension fund, there's a distinction between if the person died, whether they're aged over or under 75. But if they were aged over 75, then that beneficiary, when they want to draw from that pension fund, they've then got to pay income tax. So there could be another 40% income tax taken when the beneficiary draws that, effectively leaving them with 180,000 out of original 500,000, meaning in total that could be a 67% tax rate on pensions in total. So I think we're going to see a change to the way that we've approached pensions in the past. As we stand today, it's exempt from inheritance tax, and so kind of the rule of thumb has been don't touch your pension if you don't have to. If you need cash, use your savings, use your ISAs. They're both subject to inheritance tax, so use them first and leave pensions where they are. That's probably going to have to change now. You're going to have to view a pension as the same as an ISA or a savings account. So we're probably going to see a lot more drawing from the pension. The 25% tax-free lump sum has still stayed. Again, there was rumours that something might happen with that, but it's still here, capped at 268,000. So we might see taking the tax-free lump sum out of the pension fund and then maybe gifting it away using that 7-year rule, spreading it across the family. I briefly mentioned on the slide before there's a distinction if somebody dies aged over or under 75. That rule has still stayed. So if someone does die and they're under 75, whilst the pension pot will still be subject to inheritance tax, the beneficiary can draw from that pension pot tax-free in terms of income tax, whatever's left over after inheritance tax has been deducted. Now for the really divisive announcement, and that's the reform to the agricultural and business relief for inheritance tax. So from April 26, this is being reformed, and the position where we have it today, that you get pretty much 100% relief on business and agricultural assets, that's going, and only the first £1 million is then actually going to get relief. The balance of value is subject to 50%. Now, I found in the Treasury policy papers some explanations as to why they're doing it, and I've put it in black text on this slide. But you'll be pleased to know they've done it to help and protect family farms and businesses. That's awfully nice of them. So just by way of illustration then, let's say you've got a business, you've got a company, a farm, and it's worth £5 million. The first £1 million of value will continue to get 100% relief for inheritance tax. The balance, 4 million in this example, is subject to only 50% relief, so 2 million is chargeable at the rate of IHT, which is still 40%, gives you an £800,000 IHT bill. That's effectively a 20% tax rate on the balance. So you will have a business or a farm, and if you hang on till death, you're going to have £800,000 tax liability based on this example. So what can you do about it? Not great, but there's the option to pay by instalments. So when somebody dies, if they've got illiquid assets like land and buildings, like shares in an unquoted company, it's difficult to turn into cash. So you can pay by instalments. So you can chop that liability up into 10, £80,000 a year and pay that in 10 yearly instalments. And that should be interest-free as well. Obviously, it's best to not have that liability in the first place. So there's got to be a bit of planning that's going to be needed to be done. So as we saw there, if we had a business with a value of £5 million, you've got an 800,000 IHT bill. And here, we're going to maybe think about utilising the family a bit more, spreading the business around the family. So doing some in-life succession planning effectively. We could bring a spouse in and we could give them a share of the business, £1 million worth. If you've got children, again, you might be able to do the same, and you might therefore be able to give, say, let's say 20% to each of the 5 family members. They've now got £1 million of value. They've all each got their £1 million allowance. So where we had an £800,000 bill, we might be able to manage that down to nil, but it's really going to rely on succession planning in lifetime now. So probably gone are the days where you could hold a business or an agricultural asset until death. That's inheritance tax free, and then pass it down to the next generation. If we do that, we're probably going to end up with some tax payable. So we're going to need to look at accelerating that succession planning and doing it during lifetime. If you don't quite have 5 family members to fit neatly into this example, if you've got a company at least, you might still be able to get away with it. So in terms of company, when you're doing the valuation, if you don't have full control of a company, there's something called a minority discount. We have 4 members, let's say, in our family, and therefore we can only give them 25% each. Each share on a pro rata basis would be 1.25 million. But when you do a valuation of shares, you're valuing a 25% interest. That doesn't have control, so you can apply a discount. And when you apply that minority discount, you will probably get below that £1 million. It works slightly different for partnerships. So if you've got farming partnerships, they tend to be valued on a pro rata basis. They don't tend to get discounts for minority interests in the partnership. So in terms of making those lifetime gifts around the family, doing that succession planning early, we don't know 100% how it's going to work. There's going to be a consultation on the specifics. So that £1 million allowance, that might be a lifetime allowance. It could follow the 7-year rule at the minute, where the allowance is kind of refreshed every 7 years. So when you make a gift, you have to always look back, what have I done in the last 7 years? It might be that you look back after 7 years, and once that's gone, you might then be able to make another round of gifting for another £1 million and do that every 7 years. We don't 100% know yet. But when it comes to gifting to individuals, from an inheritance tax point of view, there's no inheritance tax implication there and then on the date that you actually make that gift. We call it a potentially exempt transfer, or a PET. So what that means is you make the gift and you only deal with inheritance tax if you don't survive 7 years. So these new rules, they're not coming until April 26. So if we're making gifts now, if you want that to be inheritance tax free, you either make the gift and make sure you survive 7 years, or unfortunately you've got to die before April 26. Because if you die before April 26, you're dying under the current rules, which say you can have 100% relief on any value. It doesn't matter if you go over the £1 million, but it's only if you die before April 26, or you can get past 7 years. If you don't get past the new rules, April 26, then you'll be into this new regime where you only get £1 million cap for your lifetime gifting. If you've made gifts before budget day, so a year ago you gifted some agricultural land, you gifted shares in a company, again, we don't 100% know the detail because the draft legislation isn't out, but we expect there to be no cap. So if we made a gift a year ago and you don't survive 7 years and you die after April 26, we think because the gift was made a year ago before these rules were announced, when you have to assess it for inheritance tax, we think that should still get 100% relief on whatever the value of that gift was and not subject to the cap, but we don't 100% know yet. In terms of gifting into trusts work slightly different to gifting to individuals. So gifting to individuals, you make the gift and you only have to consider IHT if you don't survive 7 years. With trust, you've got to consider IHT at the point you make that gift. But if we were gifting into trust today, we are still under the current rules. So in theory, we can still make gifts into trust, agricultural assets, business assets that have a value in excess of the £1 million allowance, because we can still get full IHT relief on the way in. The caveat is, if we don't survive 7 years, because we made a gift today after budget day, that £1 million cap will kick in when you assess the IHT if you haven't got past that magic 7-year period. So it may well be worth utilising a gift of 1 million or 1.3 million using the tax-free nil rate band in conjunction. It's important to note that this is a combined allowance. So it's not £1 million for your business assets and £1 million for your agricultural assets. It's just £1 million in total. So if you do have both business and agricultural assets, you have to apportion that £1 million allowance. So if you've got 3 million business assets and 2 million of agricultural assets, so you've got 60-40 split, you've got to apportion that allowance in the same 60-40 ratio. So bottom right-hand corner, you've still got an £800,000 tax liability based on a £5 million value. Why that might be important is because if you're leaving your business assets to one beneficiary and you're leaving your agricultural assets to a different beneficiary, you might need to know how much inheritance tax represents each particular gift. So we still need to follow that computation, split that £1 million allowance pro rata between agricultural and business. And I think it's also important to note that this new cap of £1 million is only in respect of assets that currently would get 100% relief regardless of their value, because not all assets actually get 100% relief for inheritance tax. So a couple of examples there. If you own land and buildings personally outside of your business, then those land and buildings would only qualify for 50% business relief. And farms on pre-95 tenancies, they still would only relieve 50% agricultural relief. So these two assets don't fall under this new £1 million kind of cap. So if we have, say, husband and wife, they own a limited company. That company, those shares in that company, they get 100% relief from inheritance tax. If they own the building personally outside of the company, as the rules, the legislation says today, you only get 50% relief. So putting some values, putting some numbers on those, if the shares in the company, okay, let's say it's a small company, but they're only worth 650, and the building that they own personally outside of the companies is worth 350, you've got £1 million in total of business assets, and you might be forgiven for thinking that, okay, that falls underneath the £1 million allowance. But because this allowance only reflects assets that qualify for 100% relief, you can only apply the allowance against the shares because they qualify for 100% relief. The building doesn't fall under this new £1 million cap, so you have to stick to what the normal rules say at the minute, which says only 50% qualifies for IHT relief, so 175, leaving 175 chargeable at 40% gives you £70,000 IHT liability. So even if you've only got £1 million of assets, it's not a foregone conclusion that you will have no IHT at all. It will depend on how you hold those assets. So you kind of need to have a review just to make sure you are holding assets in the most efficient manner, and that might be outside, it might be inside of the business rather than outside. That 350,000 of unused allowance, that's not transferable. So the tax-free 325 nil rate band and the 175,000 that you get if you leave your main residence to a direct descendant, those two allowances are transferable to a surviving spouse. So somebody dies, they leave all their assets to their spouse, that's IHT free under the spouse exemption. So you don't need to use your allowances. In those circumstances, that 325, that 175, you can transfer that, and the surviving spouse estate claims that 500,000 together with their own 500,000, they've got £1 million. That didn't always used to be the case. So pre-2007, those two allowances you couldn't transfer. So it was a use it or lose it kind of thing. So what a lot of people had pre-2007 in their will was a provision that on the first death it set up a discretionary trust into which assets equaling the tax-free nil rate band of 325 would fall into that trust, and then everything else can go across to the spouse. The surviving spouse would be a beneficiary of that discretionary trust. But since 2007, we haven't had to do those fun and games because we can just transfer it. But this new £1 million allowance is a use it or lose it allowance. So we very well may see wills having to be redrafted with discretionary trusts set up where £1 million of agricultural or business assets would drop into on first death, with balance maybe left to the spouse under the spouse exemption. So wills need to be reviewed. In terms of trusts, so trusts pay inheritance tax just like an individual pays inheritance tax. So certainly discretionary trusts. So every 10 years, a discretionary trust will have what they call an anniversary charge, where it says, what's the value of the assets in the trust? Knock off the 325,000 allowance, and then we'll tax that at inheritance tax. If you've got agricultural business assets, then they get relief. So we don't know how it's going to work, but each trust should have its own £1 million allowance, if you like, to set against any agricultural or business assets. And that applies on the 10-year anniversary, or if the trust wants to appoint some of the capital out to some of the beneficiaries. So just like an individual makes a gift out of their estate, a trust, if you like, makes a gift to the beneficiaries. That is also subject to IHT. If it's of agricultural business assets, they should have this £1 million allowance. So whilst there's going to be a consultation in early 2025, the budget papers have given us some information already, and that says if you have existing trusts that are set up pre-budget day, which contain agricultural or business assets, then each trust will get its own £1 million allowance. So if you've set up, I don't know, 3 trusts for your 3 children or your 3 grandchildren, and there's agricultural or business assets in those trusts, each of those 3 trusts will get £1 million. If you do that today, there's provisions that will say, we'll split that £1 million between how many number of trusts. So if you set up 3 trusts today and put agricultural business assets into it, you will have to divide that £1 million allowance against each trust. You'd have 333,000 allowance in each trust. On the last point there, what the budget papers don't quite clarify is what happens if you've got an existing trust in place already set up pre-budget day, but they don't hold business or agricultural assets currently. So you might have a trust with investment properties in it, or a stock market portfolio, for example. What we don't know is, because those trusts are already in existence, if we now transfer agricultural business assets into those trusts, do they still get £1 million each allowance, or will it work because those APR, BPR assets weren't transferred until after budget day? Does that mean we have to divide the limits? We don't know that as yet. But once that is confirmed, we might be able to do some further planning. So I think the message from the inheritance tax changes is you need to review your estate. If you've got a pension fund, if you've got assets that are business or agricultural in nature, you need to review your estate, look at your IHT, review your wills. Okay, moving on to employer costs, which was the big one. Just starting there with the increase to the national minimum wage, and in particular, just jumping out there, the rates for the under 21s, 18 or 16% increases. That could be a big cost to a lot of employers. The minimum wage for 21s and over is going to £12.21. Now, this is the big one. This was the money maker. The changes to employer national insurance. So the first thing that they did was reduce the threshold at which point an employer pays employer national insurance. So they've moved that from 9.1, dropped it down to 5. Now, that is the big money maker. So out of that 24 billion, the number keeps changing, but out of that 20-odd billion, the majority of that comes from changing the thresholds, not from going from 13.8 to 15. The employment allowance, which effectively is a rebate that employers can claim back off their employer national insurance bill if they qualify for it. Currently it's 5,000, that's more than doubling, so that's going to 10,500. That won't make much difference at all to a large employer, but to small employers that could be very beneficial. And I've got a slide which shows the benefits that could have. The cap, which makes you eligible to claim the employer allowance, that used to be a cap. If your NI bill was more than 100,000, you couldn't get it. That's now being scrapped. So more businesses will be able to access that 10.5, but again, for large employers, it's not really going to make much of a dent. And then finally, pension contributions. Again, one of the many rumours was they were going to levy employer national insurance on employers making pension contributions. They didn't need to do that. They were able to raise so much tax from doing the first two that they didn't need to put employer national insurance on pension contributions. So they're exempt now, and they're going to stay exempt. So if we just look the cost per employee, so that first slide there, changing the thresholds from 9,100 to 5,000, that extra 4,100 is being taxed at the new rate of 15%. That's £615 per employee. That's where the money is making, just on this threshold. If we look in terms of what an average UK salary is, which I'm told is 36,000 at the minute, only the first 9,000 is free. Above that, it's 13.8. So employer national insurance is 3,700. Under the new rates, you've got only 5,000 that's NI free. The balance at 15%. So on an average 36,000 salary, that's 4,600, which is a total of £938 per employee, which is an increase of 25%. So you can see the increase of 1.2% going from 13.8 to 15 isn't necessarily the big money maker here. It's lowering those thresholds. But I've got a slide here which shows the impact on small businesses and how the changes might even be beneficial for them. So this is all to do with the doubling of that employment allowance from 5,000 to 10,500. So that rebate that you can claim back from HMRC. So I've illustrated here with 2 employees. So a very small employer who's only got 2 employees, and I've got them at 4 different salary rates. So if you've got 2 employees at 12,570, which is the tax-free threshold, currently there's no employer national insurance. 22,222. Does anyone know what that salary represents? That is the full-time salary of someone who's going to now be on the national minimum wage of £12.21. So that would be the minimum full-time salary. Currently, there's no national insurance on there. 36,000 was the average salary, and 100,000 is just 100,000. So if you look at what happens under the new rates, well, if you're employing 2 people at 12.5, there's still no national insurance for the employer. If you're employing 2 people on the new minimum wage, again, there's no employer national insurance, and you can actually have 4 members of staff employed on the minimum wage full-time before you'd actually pay any national insurance. For the average worker on 36,000, there won't be any national insurance from an employer perspective this time around. And if you've got 2 employees on 100,000, it was 20,000 employer national insurance, it's now only 18. So for the very smallest of employers, this might actually be beneficial for them, but only for the very smallest employers. Moving on then to single director companies, one-man bands if you like. So I've got the rates there on the left-hand side for employee and employer. So employees don't pay national insurance until they have salary over 12,500, and as we've seen, employers don't pay employer NI until they go over 9.1. Now, when it comes to state benefits, it's all based on your national insurance record, and you need to make sure that you've got a stamp or a qualifying year for national insurance purposes. So the single director company, they need to pay themselves a salary. At the minute, the minimum is £6,396 if they want to get a qualifying year for national insurance, and they can pay themselves anywhere between 6,300 and 12,500. So it's kind of split strategies. Some people limit their salary to 9,100, which is the threshold at which point no employer national insurance kicks in. So there would be no employee or employer national insurance. Some people pay themselves a salary up to 12,570, which means no employee national insurance, but there would be a small amount of employer national insurance because it goes over that 9,100 threshold. Either is fine. It all depends on personal circumstances. If the company pays 19% corporation tax, or does the company pay 25%, the more tax rate the company pays, the more tax relief you get, because national insurance and salary is tax deductible for a company. So if you're looking at your personal tax liability and your company tax liability together as one. That might produce an overall lower value. And it also depends on if the director has other income coming outside of the company. So either of those two is acceptable. Going forwards, the minimum salary that you can pay in order to get your national insurance will go up slightly to £6,500 exactly. But that is £1,500 over the employer threshold, which is now dropped to 500. So single director companies, if they want a national insurance qualifying year, they're going to have to pay salary above the employer threshold of £5,000. They're going to incur some employer national insurance. Now this is where we can see if we can unlock the employer allowance, that 10,000 or 10,500 rebate, because single director companies don't qualify for this employment allowance. It's only if you've got two people or more who are being paid above that starting threshold. So we might start to see people start employing other people, members of the family. You might have someone at university who comes back and works in the company during the summer. As long as we're paying them more than the threshold, which is 5,000 on an annual basis, but only 417 on a monthly, you'll have two people above that threshold. It will unlock that 10,500, and you can offset that against your employer national insurance bill. So family members, people at university, spouses, bringing them onto the payroll, that might be beneficial now to unlock that employer national insurance. Another way that employers can kind of maybe lessen the burden of this announcement last week is to try and think about how else they can reduce their national insurance bill, and salary sacrifice is a good way of doing that. So salary sacrifice, an employee sacrifices some of their salary in return for a non-cash benefit, and that's normally things like pension contributions, childcare vouchers, and electric vehicles, because they're the tax-efficient non-cash benefits. So employee sacrifices some of their salary. In lieu, they get a non-cash benefit. They pay tax and national insurance on that lower salary, which means they pay less tax and national insurance. And the employer also pays their national insurance on that lower salary, so they save national insurance. So in respect of like an electric vehicle scheme, effectively the employer leases a vehicle on behalf of the employee, and the employee sacrifices their salary equal to those monthly lease payments, and then the tax and national insurance is worked out on that lower net figure, and there's both tax savings and national insurance for employer and employee. The provision of the car back to the employee is a benefit in kind, so there is some tax implications of doing that, but they are outweighed by the cost savings rather of putting a scheme in place. So just as an example then, for an employee, if they have a vehicle supplied to them which £500 a month leasing costs, that's £6,000 a year, they sacrifice £6,000 of their salary in order to get this car. If they're a high rate taxpayer and they're paying tax at 40%, national insurance at 2%, it's that on the 6,000. They then have to pay a little bit of tax on the benefit in kind because they've now received a car from their employer. The tax rate on employee vehicles at the minute is 2% of the list price. So whatever the list price of the vehicle is times 2%, that gives you your benefit value and you pay your tax on that. So for an employee, the net cost here is £3,700. So they're able to drive a car which would have cost them £6,000 if they were leasing it directly, but under a salary sacrifice scheme, the net cost them is only £3,700. In terms of the employer, well, the employer, because they are only paying £6,000 less of salary, they get to save that at the new rates of 15%, so they're saving £900 of NI, minus a little bit of NI that they have to pay on that benefit in kind, but there's a saving there per employer of £810. And lastly, if we just look, if we're doing it in terms of pensions on salary sacrifice, so you might have an employee with a bonus, 5,000. If they chose to take that as a cash bonus, they've got to pay their tax and national insurance. They'll be left with 2,900 after tax and NI. But if they chose to sacrifice that bonus and in lieu get a £5,000 pension contribution, the full 5,000 will fall into their pension pot, because as we've seen, there's no employer national insurance on pension contributions. And the employer then saves 15% national insurance on that £5,000 bonus. So there's a couple of ways there that might be able to lessen the impact of these employer NI changes. So moving on to capital gains tax, this wasn't as bad as we all feared. There were rumours that capital gains tax rates were going to be increased in line with income tax, and it was going to be 40% across the board. That ultimately didn't happen. Residential property, they left completely alone. So it was 18% if you're a basic rate taxpayer or 24% if you're a high rate taxpayer. That stayed exactly the same, and all they've done is they've taken all other asset classes and said we'll do exactly the same. So all assets now will pay either 18% if you're a basic rate taxpayer or 24% if you're a high rate taxpayer. And they brought those changes in on budget day itself. So there was a lot of speculation beforehand. We all thought capital gains tax would go up, but there was talk about when would those changes happen. So some people say it could be the 5th of April at the end of the tax year. A lot of people said it will come in from midnight on budget day itself. It actually came in on midnight on the day before the budget. So if you woke up last Wednesday morning and sold some shares on the stock market at 9 o'clock in the morning before the budget speech had even been given, you would still be under, or you would be under the new rates. You'd be under the higher 24. It applies from midnight the night before. Business asset disposal relief, what we used to call entrepreneurs relief, they are increasing the 10% rate to 18%. And investors relief, which is the opposite of entrepreneurs relief. Entrepreneurs relief, you have to be an employee or a director and be actively involved in the business. Investors relief is almost the opposite. You've got to be like a business angel. You've got to be just a pure investor. That used to be 10% on £10 million of gains. Entrepreneurs relief, once upon a time, was at £10 million. They dropped entrepreneurs relief, business asset disposal relief as we call it now. They dropped that from 10 million to 1, but they didn't do the same for investors relief. A lot of people actually think that the government just forgot about investors relief, and that's why it stayed at £10 million, but they've now brought that in line as well. So that'll be 18% on £1 million of gains. So for business asset disposal relief, entrepreneurs relief, it's not going directly to 18%. It's staying at 10% for now until April next year, where it go to 14%, and then the year after it's going to go up to 18%. So the benefit now is only really 60%. So if you're a high rate taxpayer, you'd be paying 24%. If you can get entrepreneurs relief, business asset disposal relief, it'll be 18%. So there's a 6% saving on 100 grand. So 60,000, not to be sniffed at, but once upon a time, you had a 10% saving on £10 million. So you had £1 million of tax benefit. Now you've only got 60. So in terms of capital gains tax mitigation strategies, rollover relief is still with us. They didn't change any of the relief. So rollover relief, if you're a sole trader, partnership or company, and you sell a trading asset and you take the proceeds and reinvest it into new trading assets, you can roll over that capital gain. Incorporation relief, again, is still with us. So that's if you're a sole trader or partnership and you want to transfer your business into a company, you can still do that capital gains tax free. Gift relief, trust relief and defer relief, I've got a slide for each. So gift relief is when individuals gift business assets. So that could be assets that are used in a sole trader or partnership business, like land and buildings. Could be shares in an untraded company. So what this says here is if you've got land, let's say you bought it for 100,000, it's now worth 250, and you want to gift it to your child, even though you are gifting it and you're not getting any money, the tax legislation says we'll treat you as if you had sold it for the full market value of 250,000. So you've got £150,000 gain at the new rate of 24%, that's 36,000. But if you make an election with the recipient who you're gifting to, you can be treated as if you'd have sold it for your original cost. So you bought it for 100,000, you're treated as selling it for 100,000. There's no gain, there's no capital gains tax. And the recipient, the daughter in this example, they have to take it on at that lower £100,000 cost. So if they were to turn around and sell the land for its market value of 250, the gain would be with them and they pay the tax. Trust relief works exactly the same as business asset gift relief. The slightly relaxed in that it can be any asset, so it's not restricted to business assets. If you're putting assets into a trust, they can be investment assets. They can be any assets that you want. Going into that trust, again, the person gifting into the trust and the trust, they make this election and you can effectively sell it for cost and pay no capital gains tax. And the last one, deferral relief, not utilised as much as it could be done, but what deferral relief basically says is if you've sold an asset, any asset, so it could be a business asset, but it could be an buy-to-let property, it could be investment portfolio and shares, anything. You sell an asset, you trigger a capital gain. If you take some of those proceeds and reinvest them into shares in an EIS or an SEIS company, so that's Enterprise Investment Scheme, then you can either defer that capital gain until such time as you sell those EIS shares, or if it's under the smaller SEIS rules, you can actually exempt completely 50% of that capital gain. So, as an example, you've sold a property, you've got a gain, you've got some tax to pay, but if you then invest into an EIS qualifying company on a pound for pound basis, that gain kind of gets frozen in time, and it only comes back into charge if and when you sell the shares in that EIS company. Now, if you hold those shares until you die, because there's no capital gains tax on death, that gain that was frozen for all those years disappears as well. So that gain may never come into charge. There were rumours, again, that they were going to change the kind of capital gains tax, inheritance tax, the way it interacts on death. They didn't. So if you die, any assets that got capital gains in them, they get wiped out, and instead you pay inheritance tax. Now, EIS companies, you kind of got two types. You can either go off to an investment advisor and they can set up a portfolio that qualifies for these shares. So you could do it that way. And if you do it that way, you can also get an added cherry on the top. You get 30% income tax on whatever you've invested, so you'll get a tax refund as well. But you can also do it for a company that is your company that you own. So if you set up a new trading company that qualifies under the Enterprise Investment Scheme, it doesn't matter that you own 100% of the company and you're connected to it, you can still defer your capital gain. All that means is you won't get the income tax cherry on the top. But if you're concerned about deferring a capital gain and not paying the tax now, EIS deferral relief might be one way to go. Okay, moving on to school fees. So it was confirmed, as we kind of already knew, but it was confirmed that the VAT exemption is going to be withdrawn from January of next year, and it's going to be replaced with standard 20% VAT. Some people try to prepay school fees, and if they'd done that before 29th of July, when the government stood up and gave an update, those fees should still be under the exemption, but any fees after the 29th of July, if they're in respect of terms, school terms starting 1st of January onwards, those fees would also be subject to 20% VAT. We can't necessarily do anything about the VAT added on to school fees, but we might be able to do some planning in terms of funding school fees in general. So I've got a slide that bullet points how we would do this, but I've got an illustration that's probably better to go through. But we have something called like an education trust fund. So effectively, we've got a family member, not the parents, sets up a trust. They put into that trust an asset that produces income. That income that's produced in the trust passes out to the beneficiaries. If it's underneath their tax-free allowance, they can receive that completely tax-free, and the child themselves goes and pays the school fees. Big tax savings, but it needs to be set up correctly, because there's a right way of doing this and there's a wrong way, and HMRC have picked up on the wrong way that people are doing. But if you do it correctly, there could be significant tax savings. So I want to illustrate this. So let's say you've got two children and their school fees are £10,000 each. With the new VAT applied on top, you're now going to be paying £12,000 each. So mum and dad have got to pay £24,000 to the school to pay for the private school fees. But in order to get £24,000 of net income, you've got to earn a lot more. So if you're a high rate taxpayer, you've got to earn £40,000, pay your £16,000 of tax, which leaves you with £24,000 to pay to the school fees. Under the education trust route, let's say you've got grandfather, they put share certificate or land or stock market portfolio, buy-to-let properties. That goes into a trust. Those properties or those assets generate income. If we can get £12,000 to each child who's a beneficiary of the trust, that's below their tax-free personal allowance. They then can pay the school. So rather than having to take £40,000 of income and losing £16,000 in tax, you can go £24,000 of income, £24,000 straight to the children because they're utilising their tax-free allowances, and you can effectively get almost tax-free school fees. So that might lessen the pain if anyone is incurring VAT on school fees. Cars then wasn't discussed in the budget itself, but in the budget documents they've announced what the rates are going to be for the last 2 years of the current Parliament. And the big hike is in terms of hybrid cars. So hybrid cars, it depends on how much you can drive purely on your electric battery, but roughly it could be somewhere about a 10% rate of benefit in kind tax at the minute, but that's jumping up to 19%. Electric cars currently is 2% of the list price is the value that you pay tax on. So it was 0, it then went to 1, it's now 2, and we knew it was going to go to 3, 4 and 5 over the next 3 years. But in 29, it's going to jump up 2%, it's going to 7, and then finally by 2030, it's going up to 9%. And they've also announced what the rates are for all other cars, and that's going to a maximum of 39%. So whatever the list price of the vehicle is, times 39%, that's the value which you have to put on your tax return and pay tax on. So effectively, unless you're a pure electric vehicle, the tax charges on certainly other cars is going to be prohibitive. The van benefit in kind is rising slightly to 4,000, so it's generally more tax efficient if you're driving a commercial vehicle, something that's not a car. And again, in the budget documents was the announcements on what's called double cab pickups. So double cab pickups have been a bone of contention with HMRC for a number of years, but ultimately now what they've said is from next year, for company car tax benefit in kind and capital allowances, they will be treated as a car. So even if they have a payload of 1 tonne or more, they'll still treat it as a car. So that's different to the VAT rules that says if it's payload of 1 tonne or more, VAT treats commercial vehicles. But for company car tax, because of a case from Coca-Cola, which basically said 2 rows of seats, you've got a double cab, the primary function of that is suitable to convey passengers, therefore it should be treated as a car. So we're going to treat it as a car for capital allowances and benefit in kind. Now, the Conservatives tried to bring this in earlier in this year, February time I think it was. There was a big uproar and they U-turned straight away within a week. Labour have picked this up and said, no, we're going to do this. There's some transitional arrangements. So if you've purchased, leased or ordered the vehicle before the changes next April, then it'll be treated under the current rules, it will be treated as a van if you like, for a maximum of 4 years, but the earliest of disposal of that vehicle when the lease expires or to the 5th of April 2029. So you can still carry on under the new the current favourable commercial vehicle rates. So if you purchase a car in September 25, so you purchase a double cab in September 25, it's a car, you'll be paying one of those maximum potentially 39% of the list price. If your lease commenced in December 24, then you're still under the current rules and you've got a maximum of 4 years or when the lease expires, if less. If you've ordered in January, so before the April change, but you don't get to pick up the car until after the changes in September, it's still a commercial vehicle because it goes on the point of when you ordered the vehicle. So that's benefit in kind. For capital allowances, again, it's moving to be treated as a car, and again, there's some transitional arrangements, and that's based on when the contract was in place. So capital allowances is the tax relief that the employer can then get when they've purchased a double cab. So as long as the contract was before the 6th of April, even if your expenditure on the vehicle is afterwards, you'd still get it as a commercial vehicle, as long as you pay that expenditure within 6 months, so before October 2025. So you put a contract 1st of January and you pay a deposit, but you don't take delivery until after April, which is when you pay the balance. Because the delivery was after April, but before October, they were still under these transitional arrangements, so you can still treat it as a commercial vehicle for capital allowance purposes for the employer. You can get annual investment allowance. Coming on to property, stamp duty land tax, they increased the surcharge for second homes and investment properties. They put another 2% on the surcharge, so that now starts at 5%, increasing all the way up to 17%. And this took effect from the day after Budget Day, the 31st of October. This has kicked in, so this is already in place now. A couple of ways that potentially you might be able to get out of the higher rate. So the first is what's known as the 6 or more rule. So if you're buying 6 or more dwellings in a single transaction, that qualifies for the commercial rates of SDLT. So you might buy a building that might have 6 flats in that building. If they're 6 self-contained flats, there's 6 dwellings, you could get away with not paying the higher rate. If you're an investor, for example, you just pay the non-residential rates. And the other one is mixed use rate. So if you are buying a second home, for example, and it has land that is used genuinely for a commercial or an agricultural purpose, that could become under the mixed use rules, and therefore you wouldn't have to pay the surcharge. The thresholds stamp duty are reducing as well, and this is something which the Conservatives actually brought in. So the first £250,000 of a purchase is at 0%, but this was only ever a temporary measure. So the Conservatives brought this in and said it will end on the 1st of April 2025. Labour have come in and said we are more than happy to let this lapse. This is not an announcement that we made. It's not a tax increase that we've put in place. It's what Conservatives did. So we will let that lapse. So on the 1st of April, we'll be back to only the first 125,000 of a property that qualifies for 0. And the same again with first-time buyers relief. The increased thresholds were only a temporary measure. Conservatives plan for that to lapse in April next year. Labour are quite happy for that to happen. So only the first 300,000 for a first-time buyer would be at 0, and nothing at all if you go over 500,000. Holiday lets. Again, it was previously announced by the Conservatives that they're going to be scrapping holiday let regime from April next year, and that is going to continue, so they will be getting rid in April. Furnished holiday lets give you quite a few tax benefits. So capital gains tax, you can get the 10% rate as it currently stands on that business asset disposal relief. Capital allowances, so you can claim for things like the lighting systems and the plumbing, electrics, etc., and you can reduce your tax bill. If you're funding it with a mortgage, there's no restriction on the interest paid on that mortgage debt. Husband and wife, they can split income and profits from a furnished holiday let in any way they want. And finally, earnings from a holiday let are treated as pension for the purposes, profits, so treated as earnings for pension contributions. All these tax benefits, they are going in April, but there is still time to claim them before April. So if you were thinking of getting rid of your furnished holiday let business, you can qualify for that lower 10% rate of capital gains tax on that business asset disposal relief. You have to sell all of your holiday let business. But if you've just got one holiday let, that is the entirety of your business, so you can sell that off pre-April and still get the 10% rate of capital gains tax, because entrepreneurs relief, business asset disposal relief, that doesn't change until April. And again, capital allowances, we weren't sure how this was going to work, so we were saying if you make a capital allowance claim for the cost of your boiler and your lighting and all that kind of stuff, you claim back tax from HMRC. We weren't sure come April, when it's abolished, whether we'd have to pay that back, but they confirmed you won't. So we've now got a small window where you can do a capital allowance claim on a holiday let, claim some tax back from HMRC, and you won't have to repay it when the rules change in April. Something that might catch people out, husband and wife. So I said before, if a holiday let is owned by husband and wife, they can split that income and profit whatever proportions they want. So it could be 75-25, it could be 90-10, whatever works for them from a tax perspective. Come April, when the holiday let regime is abolished, that holiday let will then just become a normal residential property. And if it's owned by husband and wife, the tax position is a default 50-50. If you want to be taxed something other than 50-50, you have to beneficially own that property in a different proportion, so 75-25. A lawyer will need to draft up the documentation, and you need to submit something to HMRC to prove that you own it differently for 50-50. So we might see some people who have historically split it whatever they want, come April, not realise that they're now back to the default 50-50 and could be caught out. And VAT, there's been no changes to the VAT treatment of holiday lets. So a lot of people say, okay, well, if holiday lets are scrapped, does that mean we don't have to pay VAT on our holiday lets? But the VAT legislation basically exempts residential letting, but not residential letting on short-term holiday purposes. So it's something completely different to the actual holiday let regime that applies for capital gains tax, capital allowances, etc. So you'll still be letting out a residential property short-term for holiday letting purposes. They treat it like a hotel, bed and breakfast, that kind of stuff, so it's still subject to VAT. And just finishing off with some other measures. Child benefit. So this was in the budget documentations. The Conservatives announced last year that they're going to move to a household basis from April 26. Labour have said we're not going to do that. So this was where you could have two people in the household both earning £50,000 and not pay the charge, whereas you could have another household where someone earns 100, the other spouse is non-working, they still only got 100,000 in total in the household, but because one's gone over the 50,000 threshold, they have to pay the charge. So Conservatives wanted to move to a more fairer regime. Labour are not going to implement that. They're scrapping that. They've kept the thresholds as they are because they're already in place. What they have done is they're going to make it easier for people to pay the charge. So before, the only way to pay a child benefit charge was to submit a tax return, a bit of a faff if you're not normally submitting tax returns. So now they can have that liability put into your tax coding notice. And if you do submit self-assessment returns, SARs, they will now be pre-populated with information that HMRC receive from various different agencies. The non-dom regime, it was announced that it was going to be abolished and they're going to carry on with that, so no real changes. They've just tightened up a few loopholes, but essentially the concept of domicile is going next year from a tax point of view. So anybody who's resident in the UK will pay tax on their worldwide income and gains. If you're a new arrival into the UK, you've got a 4-year period of grace where income and gains in the first 4 years will be tax-free. And inheritance tax also uses the concept of domicile. That's going as well. So now inheritance tax will be based on residency. So once you become a long-term resident of the UK, which is 10 years, you will be within the UK IHT net. And you'll stay in that net, even if you've left the UK, up to a maximum of 10 years. AIM shares currently received 100% relief for inheritance tax, business property relief. That's being chopped to 50% from next April. HMRC interest, there's two changes here. Late payment interest, so if you pay your tax late, you currently have to pay interest at 7.5%. That's going up by 1.5% from next April, so it could be 9% unless interest rates change in the meantime. And the official rate of interest is what they use to calculate things like benefit in kind. Since January 2000, they've only ever increased the rate at the start of a tax year to make things easier. They've said we're not going to do that. We're going to reinstate what we did 25 years ago, and we can make in-year increases to this official rate of interest. And lastly then, just trying to end on a slight positive, fiscal drag, which is where those tax thresholds are frozen, but people's wage growth increases above the thresholds. It drags more people into the tax net. We've been at the same rates since 2022. It was going to be frozen until 26. They then increased it, or froze it again for another 2 years to 28. There was talk of it being frozen still to the end of the Parliament in 2030, but they've decided they don't need to do that. They will start increasing by inflation from 2028. Having tried to end on a positive, I don't think we're out of the woods yet. There's already talk of having to raise more taxes. Some of the measures like the national insurance was talked about 25 billion. There's already calculations saying, what if this impacts on wage growth, then we're not going to be actually getting the 25 billion that we thought. It might be more like 20. There's already numbers banded around about needing an extra 9 billion of tax. Going back to what Gordon Brown said, hit them hard in the first year or two of your government. We'll have a budget next year. Labour have committed to having one fiscal event a year. So it looks like they're going to need to raise another 9 billion next year. And from the rumours I'm hearing, we had rumours of being dividend tax hike, which never actually went through, but some of the calculations on the numbers, if they did increase that to a certain number, it comes back quite neatly around the 9 billion mark. So if I was a betting man, there's probably going to be more tax increases to come next year. That's it from me. Thank you very much.